Hi, my name is Helvi Fillipus. I'm from the Bank of Namibia. I'll be giving an overview of the Namibian financial system. Good morning, everyone. My name is Helvi. I'm from the Bank of Namibia. I work in a department called Financial Markets, and in a division, I head a division called Investments and Domestic Markets. That's a division that's responsible for managing the state account and funding government and raising funds for the budget deficit. So my job here today is to give you an overview of the Namibian financial system or financial markets, basically looking at the institutions that we have in our market, what they do, and the type of instruments that trade basically in the Namibian financial markets. So in terms of my outline, I'll just give you a brief background. I always like, when I talk on financial markets, to start with the process of financial intermediation itself, before I then go into what type of institutions we have in our sector, and then cover the financial instruments that we have. And then later on in the end, I'll drill a bit more into the government securities, which is my specific responsibilities at the bank. So in terms of background, why do we have financial institutions, basically? Different financial institutions, your commercial banks, your insurance, pension funds, all types of financial institutions, they serve one role, and that is to serve as an intermediary between savers and borrowers. In general, you have some people have excess funds that they would like to invest, and some people have needs in terms of their projects they want to invest in, or they have businesses they want to run, but they do not have the funding. If we do not have financial institutions in the middle to bring these people together, these two parties together, your savers and your borrowers, it will be very difficult for an individual to find a counterpart to get a loan from, who would agree to the terms that they are comfortable with in terms of interest rates or length of time that you have to repay the loan and so forth. Also, the size of the loan that an individual needs. Maybe you need 10,000. If you don't have any cousin who has 10,000, where will you find 10 people who can give you 1,000 at the rate that you want, for the length of period that you want? So financial institutions then serve as that middleman. They pull all the funds from the savers, and then they get in touch with the borrowers to facilitate those transactions. It makes things easy. It minimizes risks, because your counterpart is now a bank, which is a bigger institution than you having to chase around this specific individual. So you deal with one counterparty, and then in terms of liquidity, because they are pulling money from all savers, the pool of funds that you have then to borrow from becomes bigger. And it's very easy for you, if you change your mind or you want to pay back the loan, it makes transactions very easy. Then would be the case if we didn't have a financial institution. So the type of financial intermediaries that we have in Namibia, I must say our sector is actually one of, it's very deep in terms of the type of institutions that you have. If you look at the level where other African countries are, they don't have the level or the depth that the Namibian financial system have. So we have your regular commercial banks, we have specialized banking institutions, your DB and the agri-bank. They serve the same role as normal commercial banks, but they are more specialized in terms of their mandate. They only lend for specific purposes, and they don't take deposits. And then we have insurance companies, your pension funds like the GIPF that called us here today. We have unit trusts, we have asset managers, we have a stock exchange that Tian is representing, and then micro lenders. Those are the different types of financial intermediaries that we have in Namibia. So in terms of the financial intermediation process itself, it can take place either directly or indirectly. So I'll first start with the indirect process, which is where financial intermediaries play a role. That's where you have your lenders or savers, and then we have borrowers or spenders, basically people who want money on the one side. So the process of financial intermediation then brings these parties together. It's basically a marketplace, but just a marketplace for money. There are no goods being sold. So you can either, as a saver, put your money through a financial intermediary, and then that financial intermediary comes to the market, and then the spender will borrow it from there, or as a saver, an institution or a company can go to the financial market itself by issuing a security or listing on the stock exchange in terms of shares. So that's the direct process. So in terms of the flow of funds, like you saw in the previous slide, we basically have the different sectors of the economy. You have your consumers, in terms of the flow of funds into households, you get money through your wages, or you have a business, you got profit, and then that money, you then spend it, and it goes to businesses, and then those businesses in turn will pay tax, or they will put deposits into the financial system. So that's how the circle of money, how it circles between the 5 sectors of any given economy, with the financial sector then being the interlinkages or the intermediary that connects all those different sectors. So in terms of I just wanted to give a brief, like just a high-level overview of the Namibian financial sector. Obviously, we have the banking sector, like I've said before, where we have, this is just purely commercial banks. I didn't look at the sizes of the specialized banking institutions. So in terms of the banking sector, the size of assets or deposits or the loan books of commercial banks in Namibia, as at the end of last year, was 142 billion, which is about roughly just under 80% of GDP. And in terms of participation in the financial market space, the banks tend to play in what we call the money market. That's basically your short term. So banks will borrow or lend money in the money market, which is where we are selling instruments for less than a year. So because of the way their balance sheet is structured, which means their balance sheet is mainly your deposits, which us as households or businesses place our deposits with the banks, and the deposits are very liquid because we withdraw them a lot. So because you come to the bank so often to withdraw your funds, they cannot afford to lend the money in the capital markets for longer. They prefer to play in what we call the money market, that's the short-term space, whereas the non-bank sector, those are the guys that have the ability to lend longer or to purchase securities that go longer than a year, basically. And in terms of our non-bank sector, like I said earlier, it's a very big one. It's about over 170% of our GDP, but 50% of that is made up of pension funds. So that's the biggest type of institutions that we have in our non-bank sector. And they tend to dominate, like I said, in the capital market, which is where we sell securities for longer than a year. So now, what type of financial instruments do we have? Like I said, the money market, that's where we're talking of securities or anything that matures, or if you invest in it, you get your funds back within a year. So in terms of what government issues, we call them treasury bills. There are 4 types, 3 months, 6 months, 9 months, and 12 months. We call them by days. I know that can be confusing for someone who's not in the market. And then there are also Bank of Namibia bills. These are bills basically that the Bank of Namibia issues. The bond bills only trade between the central bank, which is Bank of Namibia, and the commercial banks. And they are mainly meant for liquidity management. And like I said earlier, banks' balance sheet tend to be very short. So there could be today the bank is short because there's been a huge withdrawal, and then tomorrow someone deposits money and their position is back. So they tend to at times need short-term securities to manage their liquidity positions. And then we also have NCDs. Those are negotiable certificates of deposit that banks issue. On the capital market, and Tian will kill me for this, I forgot the shares. I'm only realizing it when I saw him, I'm like, oh my God. So I only put put bonds because that's my space. I apologize. So in terms of bonds, the government issues what we call fixed rate bonds. So you basically invest your money in an instrument. I'll give you more details on them later. I have a list of all of them. But your income or the interest that you earn is fixed over the life of that instrument. Whereas inflation-linked bonds, the interest that you get paid changes based on what's happening to inflation. So what inflation-linked bonds, the advantage they have over the fixed-rate bonds is that they protect the purchasing power of your investment. So what you can buy, we adjust it. If the prices of goods are getting expensive, we adjust the interest that you are earning such that you are still able to buy the same that you could buy before. So we take into account what's happening to inflation. So there are also corporate bonds that are listed on the stock exchange. Those are issued by, we have SOE bonds, not as many as we want to have, but there are a few of them. And then we also have bonds that are issued by private institutions, basically, that goes to the market directly. I should say the area of corporate bonds is not, we don't have, the size is very, very small relative to what we would like to have. So if you recall my chart that I had earlier, so that channel of directly accessing the financial markets, it's not being utilized to the level that we would like it to be in Namibia as of yet. And then the other instruments that we have is the bonds that the government issued in foreign currency. Basically, they raised money in on the London Stock Exchange as well as on the JSE. So in terms of the bonds that we issue for the government, I've highlighted in green the inflation-linked bonds, and as you will see, there are, I think, 5 of them, and then the majority of the bonds are fixed-rate bonds. So basically, say for instance, let's take the top one, which is a GC21. What that means is the government is promising to pay you 7.75% of whatever amount you have invested every year, and then on the 15th of October 2021, you get back whatever amount you have invested initially. That's how bonds work. In contrast, for instance, the treasury bills that I was talking about, say you bought a 91-day TB, you don't get, if you bought a 3-month TB, you give me money today, and then in 3 months I give you your full amount back. We call it a discount instrument. So if you say you are lending me 10,000, depending on the interest rate that we agree at, you give me 9,500, and then after 3 months I give you a full 10,000. So the difference between what you paid me and what I give you on maturity is your interest. Bonds work differently. So I promise every year, so like say for instance a GC50, the government is promising if you bought it today, between today and 2050, which is the 15th of July 2050, if you give me 10,000 today, they'll pay you 10.25% of that 10,000 every year until on the 15th of July 2050 when they give you back your full 10,000. So that's how the bonds work. So we have quite a fully developed yield curve, I would like to think. Yes, we have that's the curve. Basically what this is showing is the interest or the yield if you are buying any of those securities, and what we have on this axis is how many years left to maturity. So I just wanted to talk a little bit about the government securities issuance process. So basically how that happens, because I think we've had, I think that there's a general, maybe a lack of information or understanding in terms of how government actually borrows, and I think we've read also in the papers insinuations that government is going to take money from GIPF and all those things. So I just wanted to clarify the process of how we raise funding for government. So the process basically starts with the budget, which usually the Minister of Finance would table in the National Assembly. So when that budget is tabled, the minister then announces what the deficit is. So the deficit is basically your difference between the projected revenue and expenditure. So we know, once the budget is tabled, then we know what the deficit is for the year. So what we do once we have that size, then we will look at the different type of instruments that we can issue. As Bank of Namibia, we sit between ourselves and the Ministry of Finance, and then we come up with a borrowing plan, basically, to say this year, for instance, this year we have one of the biggest budget deficits in the history of the country, 12.5%. So that's 21 billion that we need to raise this year. So what we had to do is then to come up with a plan. Where are we going to get this 21 billion? So we look at, like I showed you earlier, the type of securities that we can issue. It's either we go issue one of all those domestic bonds. First of all, you look at the size. You have 21 billion. Is that something that I can raise in the Namibian market? Or do I need to look beyond my borders? So we come up with that borrowing plan where we basically review what the market appetite is. So we have very good relationships or understanding of where all the different players in the market, so we know what their appetite are. For instance, like I said, your commercial banks mostly, they want money market instruments. You have your pension funds that want long-dated instruments. We know what the size of their balance sheet is, so we know how much they generally can absorb. And then we decide, is the list of bonds that we have sufficient? Should we come up with something new? If we then realize we need to introduce a new bond, then we go and list it on the stock exchange. Then what we do is we have a roadshow. Usually we go meet those investors. We talk to the commercial banks, we talk to the asset managers, we talk to the pension funds and tell them this is our plan for the year. We are going to come to market to raise this much money. This year it's 21 billion, that's what we are working with. And then once we have a plan, we then roll it out in terms of a calendar. We issue a calendar every 6 months. So we have a calendar that basically details every week what activity we will be issuing, how much are we planning to raise at each of those auctions. So once we have come up with a plan, we then share it with the market so they know the calendar and what activities we are going to be undertaking on what date. And at the moment, we do auctions on a weekly basis. Every Wednesday, we are auctioning bonds. Every Thursday, we are auctioning treasury bills. And institutional investors, which is your commercial banks, your pension funds, and all those institutions, are free to participate in the auctions. Individuals can also come to the auctions. The participation is very low. I'm guessing maybe a bit of information, but we do have some individuals that come to the auction. In terms of minimum amounts, if you want to buy a treasury bill, which is your money market instrument, the minimum is 10,000 you can invest. For bonds, the minimum is 50,000. And we have a system called Bloomberg where we host the auctions on a weekly basis, and then we disseminate the results to the public. I'm just showing the sample of our current calendar. I'm not sure if you can see, but that's the calendar in terms of what date we are auctioning what instrument. So this is publicly available on our website, and everyone is free to participate if you have funds that you want to invest. And yes, we're thankful GIPF is one of the investors that come to our auctions. So that rounds up my presentation.